So far we've been learning the auditing process. We started by understanding what audit and assurance is, and we dealt with ethical and professional reviews issues about the work of audit. And we started the audit with audit planning. So we learned audit planning and audit strategy. Then we started gathering evidence. And so we learned how to gather evidence. We learned how to use an expert. We learned how to rely on the internal control processes and all those things. So all those things were the process of getting evidence. We learned evidence, and we learned the concept of how you get evidence, which is the use of the vowels, the source of the evidence, which I gave you that 3, and the reason why you are looking for the evidence, which I call the assertions. Okay, so we learned all those things. Now the concept is that we are about finalizing the audit. We are concluding the audit. And so right now, what we are looking at is that we are coming to review the audit, the entire audit process. We are coming to review it and finalize it. So what we are doing today is called audit review and finalization. Then we will end it up with audit communication, which is the report. All right. So we are looking at review, finalization, and audit report. All right, and this in your exams is question 3 for 20 marks. So you need to brace yourself for that. Now, the first thing you do after you have audited the things in the current year is to actually go back and start reviewing the opening balances. The opening balances is very, very important. You have to check the opening balances. Now, last week I made mention of how people can take money out of petty cash and pushing it through opening balances. Yeah. So most of the time, what people do is that the person will chop the money and go and post a transaction. I want to use the word fraudulent transaction, but let's say he will just go and post a transaction in somewhere 2 years ago. Because if you post the transaction this year, you will know that it's a fictitious transaction and it never happened this year. And so therefore, Beka could post, using 2 years ago's dates. Now, when those things happen, the effect is on the opening balances. So it is very, very important that you review opening balances. So auditors must always review the opening balances. The opening balances are not things that you audit. They are things that you review, because you came to do the audit last year, and so you have the opening balances of the company with you. So when you have come to do the auditing this year and the opening balances have changed, then it calls for it calls for serious issues or serious review. All right. So it means that you need to always check opening balances. You need to check opening balances. So as part of your review work, it says that yes, last year's figures will also be included in the financial statement as comparatives. We all know every time you prepare financial statement, you prepare it for like 2 years. Why? Because you do the current year on, then you add the comparative of last year. So you need to be careful about the balances, because the closing balances of last year is the opening balances of this year. So you need to always be careful. As an auditor, you need to review. So the auditor must ensure that the opening balances do not contain any material misstatement. That is the auditor's job. All right. So as part of your review, so if the question asks you what are some of the things you do in reviewing the work that has been done, the first thing you need to check is to review the opening balances to make sure that there is no material misstatement in the opening balance. All right. So that is that. Again, you should also make sure that the accounting policies are consistent. Those of you know IAS 8. In fact, you don't need to know IAS 8 because this is the basic of accounting. That consistency. You can't change things like that. Yes, you can't do that. You can't do reducing balance last year and this year change it to straight line method and change it to reducing balance and change it to no. One of the qualitative characteristics of financial reporting is comparability, which speaks about consistency. So what the auditor is supposed to do, number one, is that opening balances contains no material misstatement. There is no material misstatement in the opening balances. That is it. Number two, that there is consistency in the accounting policy. Accounting policy is IAS 8. There is consistency in the accounting policy. All right. And proper disclosures have been made. So if there is any changes, yes, Eben.
Listen, the first point, you said there is no material misstatement or material. Thank you.
All right. Okay. So that is that. No material misstatement. All right. So make sure there is no material
misstatement. The second one is the consistency on accounting policy, right?
Yes, please. All right. Then lastly, the comparatives agree with last year's own. Because listen, this thing is common sense. Let's say you did 2022 account and you are coming to do 2023 account. Will you be happy if the PPE you had here, the closing balance of PPE you had here is 5,000 and the opening balance of that PPE has turned to be 49,000? Will you be happy? Something has gone wrong somewhere. So you have to check that the opening balances corresponds to the way it was last year. In fact, this is the basic of every audit. Like there is something, even you, the entity, before you even send your trial balance to the auditor, you have to check that you have done this thing before you even send it out. Yeah, it's very, very important. All right, so check that the comparatives really agree with previous years. All right, so that is that. It's very, very important to check that. All right, so an auditor is supposed to check that. But the problem is that, what if you are not the one who did the last year's financial statement, who audited it? Because if you are the one who audited it, you can have it. So if there is any change, you will see it quickly. But what if you are not the one who audited it? Let's say this is KPMG who have done it. You are now PwC, you are on board. How will you get the opening balances? How will you get the opening balances? Yes, any idea? Guys, let's make it a discussive thing. Well, how will you get it?
Yeah, you call for the previous year's accounts.
From who? Be specific. Call who?
From the company. But the company you are going to.
You have not completed your statement. I'm listening. You call who?
Yeah, so you know the law gives you that power to request for any information that you like as an auditor. And so when you go there and then you realize that the previous year's audit, or which, even though you're not the one that did it, you have the right to call for some information from those years audit, even though you may not have audited it, and your company may not have audited.
Yeah, I get your point, but you say you call. I want you to tell me the source of the calling. It's like you are saying something, but you are hiding something. You call for it from who?
From management.
From management. Okay. So that is, so you don't, it goes into the way you answer your questions. So be specific about the areas. Of course, when you go, you need the prior year financial statement, all right, which is audited and signed. You will need it. So from that, you will see the figures that are there. Okay, you see the figures that are there. But the you can also you know, when we're doing the ethics, we said that you have to seek professional clearance from the one who exited before you came. You remember that?
Yes, sir.
Yeah. So if there is anything that person can give you to, it is allowed that they can give you what they have to give you for you to. It's a professional thing. All right. It's a professional thing. Okay. So basically that is that. That is that. Okay. So that is all you need to get for opening balance. It's not anything giddy giddy bia. What is there is that you have to make sure that the last year closing balances agree with the current year's opening balances. It's very, very important, because without opening balances, you cannot even do your closing balance for the current year. Accounts are on year basis, especially the balance sheet. So if there is any prior year adjustment, you agree, all right, you work on it. All right, so that is that. All prior year adjustments are correctly done and rightly disclosed. All right, so that is that. All right, that is all you need to know for opening balances. Please, any question? So opening balances is ISA 510. ISA 510 and a little of ISA 710. All right, please, any question on that? Any question on that? All right. Then we are reviewing it all. It's like we are done with the audit. We are finalizing it. We are going through the things one more time. Okay, so that is what we are doing. So first thing is to do what? Is to do a check on the opening balances. All right. The second thing you have to do is to go on and do what we call another review. We call that one an overall review. Overall review. All right. So that is that. And that I'm going to focus on analytical procedure, and we will talk a little bit into analytical procedure. All right. So overall review. So in the overall review, we are looking at analytical procedure. The last time we discussed analytical procedure, and I told you that I will go further into it. Now, analytical procedure happens in the 3 stages of the audit process. It happens in the 3 stages of the audit process. Analytical procedure happens at the planning stage. Planning stage of the audit. And it has its purpose. All right. The reason why you are doing that analytical procedure. Then during the audit. All right, in the process of the audit and the finalization stage to this final review to you do analytical procedure. Now, who remembers the description we gave for analytical procedure last week? You said analytical procedure was what? Yes. Don't make it look like you didn't join the class, and if you joined too, you didn't hear anything, please. What did we say about analytical procedure last week?
We said it's about making comparisons.
Yeah, it's about making comparisons. Thank you very much. So we said that comparisons such as budget versus actual, last year versus this year, the entity versus the industry average and all those things. All right. So that is that. Now, analytical procedure is done here in the various stages of audit. So last week, what we were doing was evidence gathering. So during the audit, we use analytical procedure to gather evidence. So we use it for evidence collection. And that is what we learned last week, that we can use analytical procedure to get evidence. So it is part of the way we do our substantive testing. We learned that last week. All right. But even at our planning stage of the audit, we also use analytical procedure. We compare. What do we compare? Because before you start an audit, the company must send you their draft financial statement, which is their drafted trial balance. Those of you who really don't have this kind of experience, what happens is that you, the company, you will send your trial balance to the audit firm. At the end of the day, when they come and do their audit, they will give you what we call the lead sheet. Lead sheet. Okay, so after the audit, any adjustment and everything will happen, and it will now be moved from a trial balance to a lead sheet. It is out of the lead sheet the company can now rearrange the figures and call it a financial statement and add the proper disclosures. So that is what happened. So here you get the draft financial statement, which is the trial balance. Is my ink slight or it's okay? That's a faint visa. Nice, my eyes. All right, so this is the trial. This is bad. That's the trial balance. So you get that. Then you compare, you the auditor, you obviously have your own expectation. So you compare it with your own expectation, the auditor's expectation of how he thinks the financial statement will be. Why? Why that? Why? Because he has to do that to highlight places of risk of material misstatement. That's the main reason. To highlight risk. We've done that, risk of material misstatement. So he looks at your trial balance and see that some of the figures are huge, these figures are huge. Then he now spot that, oh, okay, per my expectations or per my analysis, I'm foreseeing that this figure that is so huge, I must do a deeper work over there because there is a likelihood of risk of material misstatement happening at those sites. Okay, so if you see somebody's financial statement, now revenue near 5 million Ghana cedis. Now, expenses been expenses near 1,000 Ghana cedis. What the auditor does at that planning stage is to actually highlight those big figures. When they go to the field, they should be focusing on. As for the 1,000, it's even immaterial, owing to the fact that revenue inquire 5 million. So when they take your trial balance, what they are highlighting is the places they believe that there can be what? Risk. So that is what they do at the planning stage of the analytical procedure. Now, during the audit, we said that one, they use it to gather evidence, okay? They use to gather evidence. So over there, they make the comparative. For example, a typical example is depreciation. Why is it that the entire industry is using straight line method, but one company and also will use reducing balance. So that is where they will compare something like your depreciation policy versus the industry practice. The industry practice. If the industry is using straight line, why is it that you, the company, you'll be using reducing balance? So those are the things they do using the analytical procedure at the evidence gathering stage. Then at the finalization stage, we do analytical procedure. Now here, it is no more a drafted financial statement. It is what? The final statement. The final financial statement, which is the lead sheet. From the lead sheet. Now, you now compare those things versus the auditor's expectation that they had at the beginning. The expectation that they had at the beginning. All right. So that is that. Then why are they doing that? They want to see if their expectations of risk were actually materialized or there was something that changed during the audit. Okay, so that is basically what they are actually using the analytical procedure at the final stage to do. That is what they are doing. All right, so basically this is what auditors go through in terms of finalizing things up in the financial statement. So they do analytical procedures. They do all those things. They do all those things. All right, so that is that. Now, at the review stage, it's not only analytical procedure that they do, they also try to finish the audit plan. You know, they started the audit with a plan. So you are reviewing your audit plan as an auditor. Okay, we said we will do A, B, C. So not only analytical procedure they do at the overall review. Analytical procedure is just one of them. In fact, I must say that is the first thing they even do. So is it like they have sufficient, they actually go ahead to review or look at their audit plan? Have they finished everything they plan to do? So just after the analytical procedure, I said that this one, why are they doing that? To see if everything went on as planned, right? If everything went as planned, that is their expectation. The expectation materialize. Now, the question is that after we have done with this one, do we have sufficient appropriate evidence to back up our opinion? That is what they are looking at. That is what they are looking at. Again, they are going to add all the immaterial mistakes. All the immaterial mistakes add up. So is there any uncorrected misstatement? What are they doing at this stage? They are going to add up. So they will add up all the small, add up all the immaterial misstatements. You add all the immaterial misstatements. And if you add it up, if you add all of them up, will it sum up to become material? All right, to see if its total will be material. Will be material. Okay, so that is what they are going to do. If they sum it all up and the total is material, then it is going to affect their opinion. So if the total is material, what does it do? It affects their opinion. It affects the audit opinion. And in this case, it means that the financial statement is not what? True and fair. But if it is not material, if they add everything up, and the total is immaterial. What do you think they will do? Who can guess what they will do? Yes, what do you think they will do?
A modified opinion.
Not really. If it is immaterial, it is immaterial. So, like you said, you said modify or unmodified.
Unmodified.
Oh, okay. So unmodified opinion. That is it. Unmodified opinion. Then after they've given the unmodified opinion, they will communicate those small things to the entity. So that is why they will communicate to the entity. So that is why after the audit and after your opinion, they also give the directors a letter. What is the name of that letter? We've done that. What is the name of that letter? The letter from the auditor to the management or the directors. What do you call it?
Management letter.
Management letter. All right. What about the one that is coming from the management to the auditor? What do you call that one?
Engagement letter.
No.
Management representation letter.
Management representation letter. So you come in your exam, distinguish between management letter and management representation letter. You should know. Yeah, I think we started these things in the early stages of our meeting. All right. So that is that. All right. So take note of that. So this is what happens at the overall review. Okay, overall review. We've talked about the fact that the client's policy is checked. All right, even at the opening balances place. Like if they've changed the accounting policy, proper disclosures must be also be done. All right, so that is that. You see, this thing I'm doing, I say it's unnecessary. By the time we pick a question, I expect you to bring all these things back home, and it is the same thing you'll be required to be using to answer. So please don't let it look like you have joined the class and you are doing something else. Please, that one the always I mean, I'm not happy with that. All right. So that is that. That is that. So if you have your manual, these things are discussed. All right. They are well discussed. Okay. So deeper discussion are there. All right. So that is that. Then the next thing we are going to look at is subsequent events. Subsequent events. Please, the subsequent event is there is an accounting standard that is also called subsequent event. Who knows that standard? Who knows that standard? Those of you who are doing reporting and things, what is the name of what is that accounting standard? So we are looking at Ansah 560 now. Subsequent event. Yes. Hey, is it that it can be possible now? Please. The way you people assume that you don't know, they are dangerous. So because even if you join 1 year FR now the masters by you can't tell me you didn't do those things in your masters. Then how did you get the exemptions? What is the accounting standard that talks about subsequent events?
Hello?
Yes, please, Eben.
This is IAS 10.
IAS 10. All right. So here in Ansah, we call that one Ansah 560. All right. But in accounting, it has its link as IAS 10, events after reporting date. All right. So that is that. So that is what we are going to talk about now shortly. That is what we are going to talk about. Please, these are all part of the review process that you go through to do as part of your audit work. So we call it event after reporting date. Okay. So subsequent events. All right. The concept here is very simple. And I'm going to use a diagram to teach this so that probably to help you understanding. So let's do this. All right. Now in audit, let's say this one is our accounting year ends 31st December each year. So this date we have here will be 31st December. Please, like I said, don't think this thing we are doing is just doing sake. When I get to the practical aspect of you using it to solve your exam question, now pretend they say, oh, yeah, I will not even mind you. Yeah, I will not allow you to drag us back. No. It's like Obia and the Onimsi class now one join it. Now, yeah, drew baby, I solve a question. No, besides say, why is it like that? Me, I won't mind you. I will refer you to go and watch the video. Yeah, that's what I will do. So this is it. This is 31st December this year. All right. So the accounting year ends 31st December. That shows that the accounting year probably started when? 1st January of that year, that particular year. And so before this date, audit takes place. Audit starts somewhere here in October. And that period, what is the name of that audit that they come to do? That stage of audit. What do we do over there at this place? The audit they come to carry out somewhere in October, November. What do we call that audit? Any idea?
Interim audit.
Interim audit. So you have interim audit here. And the interim audit, the purpose of the interim audit is to come and understand the internal control process. So they come to audit internal control. I've told you since last 2 weeks or 3 weeks coming that audit has 2 stages. We have interim audit, we have the final audit. The purpose of the interim audit to come and examine the control. And so when we were doing the audit risk, I told you that there is control risk and there is what? Inherent risk. And before they can get to the inherent risk, it means they must audit the control risk. So that is what they do here. That is what they do here. All right. Because evidence are gathered by 2 main means: test of controls and substantive testing. So the test of controls is what they come to do here. So the test controls. The test controls. Nobody will come here. Ebimunso have been abusing this thing to their benefit. They will prepare financial statements, from November to, let's say, October. They really do audit there. At the time they come, now the audit work that they are coming to do is somewhere November. But you see, things can happen. So many mistakes can happen. What if they now correct all those things in the month that you came to do the interim? So there is really no need. So come and check if they do bank rec. All right. So it means that by that, if they are controls, you look at their control financial policy and examine if they've been administering it as they said it is. So basically that is that. So here they've come to do the test of control. Now this is the year end. Okay, that is the year end. Now you, the auditor, you will come and do your audit here. You come and do your audit here, the final audit. Now, bear in mind, the final audit you are doing is in respect of events that happens during the accounting year. That is what you are doing. That is basically what you are there for. So you are auditing those things. But between the financial year end date, okay, and this date is the date probably you finished the auditing and you have issued this is the date you'll be issuing your audit report. Your audit report. So what happens? You do the audit, the directors sign the financial statement, and you issue out your audit report. So that is that. Now, certain things can happen here within these dates, this period that you have here. So, and those things can have effect on the things that happen here. So we call some of the things adjusting events and non-adjusting events. Yeah, so that is what we are trying to look at. So everything that happens between this date up to this date, we call it event after reporting date. Event after reporting date, or event after the reporting period. So in your final audit, you are checking your substantive testing, you are checking things to issue the audit report. You realize that, oh, okay, certain events has happened. But what you should bear in mind as an auditor is that between this time, the financial year end date, and the time you do your audit report, you have an active duty. You have an active duty. That is something you must know, because that is when you have gone to do the audit. You have an active duty. All right. Now, so if any event happen here in this period, you are meant to make all the adjustments that has to be done, and those adjustments are all corrected before you issue your audit report. So if there is opening balances misstatement, all those things are supposed to be corrected before you issue your audit report. Please, is that okay? Do you understand up to this point? And is there any question?
Yeah.
All right. You know, when you issue your audit report, everybody has signed and it is good to go. So this time in here, the time here, you are waiting for the AGM to happen, the annual general meeting. Okay, the annual general meeting. The annual general meeting, what happens is that they are going for the annual general meeting to actually authorize the financial statement. That is what they do. They authorize the financial statement. And it is at that place, if they finish authorization and they have to demand dividends and anything, they do. So that is that. So at this place, once they vote and authorize the financial statement, game is over. Everything is gone. Yeah, we financial statement no one's a message. But you see, what happens then if after you have issued your audit report, you have gone ahead to issue the audit report, then somewhere to the date where the AGM is going to happen, let's say somewhere here, you now find out that there is an error in the audited financial statement. What you audited and the opinion that you have given is wrong. Like, oh, there is a big error that has happened. All right, an error is found and it is before the AGM. What will you do as an auditor? Now, you see, it's either the entity finds out the error or you, the auditor. You see, the problem is that once you sign the financial statement, the auditor, you've left site, you've gone to your office. You've gone to your office. And I mean, there is something that has happened, probably the entity didn't tell you. And so it has affected your opinion. You said it is true and fair, but meanwhile, it is actually not true and fair. It's actually not true and fair. So in that case, what are you going to do? What do you think you should do? Any idea? Just a suggestion. Just talk about, I mean, think about something and talk. Because sometimes, even in the exams, you may not know. You have to think and do something. So what do you think you should do? Now that you have found an error. Now, let's say the error that is found by the entity, they have told you that, oh, Mr. Auditor, we didn't give you this thing before, but we have found out and it is wrong. Oh, it has made your opinion wrong. Oh. What do you think as an auditor you would do? Yes, Adelaide.
Okay.
Hello.
Hello,
Yes,
sir.
Adelaide, I'm listening.
Hey.
Okay, I think because they have confirmed from their side that they didn't actually release an information I needed, I would want them to put it into writing first.
Mm-hmm.
I think
And
that
then
would
what?
be the first thing.
They put in
And
writing. Mm-hmm.
then have a discussion with management.
What discussion? When you're answering my question, I want detail. Oh. Don't leave it vague like that. What discussion?
Okay.
Is it discussion
Okay.
about food you want to buy?
Okay, so if the error that they have actually identified, whatever they have identified, after putting it into writing, maybe we would have to meet over that and have a discussion. Then maybe see the impact as to whether it's a big one or a small one.
Okay, let's say it's a big one. What do you do? What do you think you would do?
Then I would suggest we do the audit again.
All right. That's
Yes.
fine. That's very good. Yes, who else? Anybody who wants to also say something? Yes, Noble.
Yeah, Chief, I think the report had already been signed, so the auditor will do nothing.
I get you. I get you. The report has already been signed. That one is true. It's true. But the auditor can do something. You see, the auditor's job is to the shareholders, and that is why they will have the AGM. AGM meeting is a meeting of shareholders, directors, and auditors. The auditor. All right. So it is that place they discuss the financial statement. But you've not gone there yet. It is before the AGM meeting. So it's not like you cannot do anything. Okay. It's not like you cannot do anything. There's something you can do.
Then you have to adjust the financial report.
Yeah. So like the Adelaide said. So what will happen is that you will have to. So if they find the error and they tell you, so it's either they tell you and they want to make the amendment, or they don't tell you, or they tell you but they don't want to make the amendment. So have you seen the three instances? One, they didn't tell you, so you don't even know. So that one you don't know, cry. Two, they found it, they've told you they want to make amendment. Three, they found it, they've told you, but they don't want to make any amendment. So these are the likely things that will happen. Now, so what will happen is that if the error is found, the auditor can be told or not told. All right, that is it. That is it. So if they've told you, then as an auditor, you have to extend your active duty and let them do the correct thing. So here, you will extend your active duty. So they will make the necessary adjustments. You extend your active duty to audit it, then you issue what? A new audit report. You issue a new. You see the way when this question come, I say, that is your exam question. What do the auditor do now? So probably your answer will be like, the report has already been signed, so there's nothing the auditor can do. You see, then Adelaide will be writing, okay, if it is big, they will discuss, but you are not hitting that, you are not saying anything. And so, but now can be so now one can. That is it. This is a clear exam question, you should even be careful. And when we start the past questions, you see it. You see it. So you extend your active duty, you issue a new audit report, then the directors now sign the correct one again. Okay. So please, can you mute on your call? Somebody is making a call. Can you please mute? All right. So that is that. That is that. So after this new audit report, the auditor now has a passive duty. Anything that happens, if it is so, because it is now getting closer to the audit opinion. When it does the new audit report and leave site, that one, whatever happens, is a passive opinion. So what have you learned? What you've learned is that, number one, there can be a late error that is found. All right. And when it is found, client does not make any change. And the client, in a case where client does not make changes, you will see the impact of the client not wanting to make changes in the audit report. So if the thing is found, an error is found, the fact that an error is found tells you that, in your number one, the audit report is wrong, because an error has been found. The audit report as it stands is currently what? Wrong. So you take note of that. Now, the thing is that, would the client tell you? So yes, the client has told you. All right. The client has told you, but doesn't want to make the change. So if you get to be aware of it, what then do you do? What you do as an auditor is that you tell the shareholders that this is what happened. You tell the shareholders, you are working for the shareholders. So if you find an error that is making your this thing wrong, you can't keep quiet and serve it to the shareholders like that. You need to inform them that there is something wrong. How do you do that? You tell them at the AGM meeting. If the AGM meeting is so close, at the AGM meeting, if it is so close that you cannot do anything about the timing with which you found out that something was wrong. All right, that is that. So you tell them at the AGM meeting, you go there and tell them. Now, if the time is wide and still the client doesn't want to make the proper changes in the financial statement, what do? You tell the shareholders in writing. You tell them in writing. You write to them before the AGM meeting, so that once they come and they see the financial statement and they pick it, they know that, you've told them something already. You've told them something already. This is where, when the client is listed, it's a listed entity. If the client is a listed entity, you have to also make a stock exchange announcement. You have to make a stock exchange announcement because the client is listed. Please, this part, you see, I've changed the ink. I expect you to remember it. If the client is a listed entity, make a stock exchange announcement. All right. What have we learned again? We've learned that there can be a late error that is found. And client wants to really make the change. So they correct the financial statement. So now, if they've corrected the financial statement, then it means now the financial statement is correct. So what do you do as an auditor? As an auditor, you check if the correction is made properly. Check. if the correction is done properly. That is that. Which means that, like we said, you extend your audit active period. You extend your audit work. All right. So then we said that you issue what? A new audit report. All right. Okay, so this is ISA 560. If subsequent event, what you do. All right, that is what you do.
So
Ladies
go
and
up
gentlemen.
so that I'll pick something from that down.
Oh, okay, okay. Is it okay?
Issue the new. Okay, I'm coming.
All right. Please, any question on this one too? Any question?
Hello, sir.
Yes, please.
Please, so where there's the need for the auditor to extend the period, I want to find out who bears the cost.
Hey, I need the entity now. any hour an auditor spend on your work, the charge is on you.
Okay.
Because you should have provided the auditor with everything. You didn't do one or two things, and as far as we are concerned, the mistake is because the entity didn't do something right, which they've now
What
found.
was in the cases on the auditor's side?
As an auditor, they have to do all due diligence before they sign their work. If it is coming from their side, you don't expect to be paid. But you see, at the end of the day, it's not the auditor that prepares your financial statement. Do you know that? You are prepared. He is the one auditing. So it is you that didn't show up something in the financial statement. So the auditor is expressing his view on what he has. Please, are you getting it?
Yes, sir. Yes, sir.
Yeah.
Yes, sir.
So hardly do you see the thing coming from an auditor. All right, Mr. Charles, is it okay? Mr. Richard, is it okay now?
Yes,
Can we
sir.
move on?
Thank you. Yes,
All right.
please.
Thank you very much. All right, so that is that. That is the next thing that we speak about. So that is a subsequent event. All right, so that is what I've explained. All right, made it short for you. So the diagram that I drew, those of you who have this the manual, you will see the diagram that I drew, well nicely explained. All right, with things here. Okay, so that is that. That is that. Then the next thing is for you to do another check on the entities going concern. You see, we started with ISA 510, opening balances check. We did ISA 520, analytical overall review and analytical procedure. We've done ISA 560, which is subsequent event. Now we are going to ISA 570, which is going concern, which I have taught already. I taught it when I was doing the audit risk. Those of you who remember. And I'm going to ask that question now. There are three things when we were doing the inherent risk. I gave you some three things that I told you that these are the same thing that you use when you want to check how going concern an entity is. Do you remember? Do you remember?
Yes.
So what are those things? ISA 570.
The financial issues, the operational issues, and the reputational issues too.
All right, that's very good. That's very, very good of you. So those are the things. It actually says that you listen or you learn. Yeah, that is very, very good. All right. So that is that. So that is the next thing we are going to talk about. Going concern. going concern. So, on going concern, the first thing you should understand is that number one, directors prepare financial statements. And this, we talked about the very first day we met. So it is not the job of the auditor to prepare financial statements. All right. Now, according to IAS 1, which talks about the preparation and the presentation of financial statements, it says that an entity to state emphatically that the financial statement that they prepared is on a going concern or not, they have to state. So preparing a financial statement as part of going concern. So when we did the ISA 560, it was linked to IAS 10. This one too is linked to IAS 1. All right. So you are supposed to prepare the financial statement. The directors are supposed to do that, and they must prepare it on what? Going concern, and they must disclose it. What is going concern? Going concern is the assumption that the entity will continue to operate for a foreseeable future, and there is no intention of what? Winding it up. So that is going concern. So every entity must, because without going concern, you will not have a receivable. Without going concern, you will not have a payable. Yes. So that is that. So the entity is supposed to prepare financial statements on the going concern, and all threats, any threats on going concern must be disclosed. Must be disclosed. So if they don't disclose it, it means the financial statement that they prepared is wrong, a big wrong. All right. So that is that. That is that. Now, what is the job of the auditor? So, like we've said, as for the entity, their directors are supposed to what? Prepare the financial statement on a going concern basis, that the company will not cease its operation, and they have no intention to also cease trading between the next 12 months. All right. And because of that, any financial difficulty, anything that they have, any threats towards that must be disclosed. So what we are saying is that threats must be disclosed. We call that thing material uncertainty regarding going concern. These threats, we call it material uncertainty regarding going concern. Some of you might have seen it before. The shortfall is called MEG. All right. So that is that, material uncertainty. All right. So that is that. And they have to prepare it on going concern basis and also disclose any material uncertainty regarding going concern. Now, as an auditor, what are you supposed to do? The auditor has to evaluate the going concern assumption. If they say the thing is on a going concern, it is the job of the auditor to evaluate the going concern assumption of the entity. Is it truly that the entity is on a going concern? So evaluate that assumption that they've done. That is the job of the auditor. You are going to, and when you evaluate it, what is going to happen is that you are going to conclude if a material uncertainty exists. All right. If it exists, have they disclosed it? All right. And conclude if the assumption is correct. And all threats have been disclosed. All right. So basically, that is that. As for the indicators of going concern, those are the things we've done already. So how him evaluating it are those things my friend mentioned. So how is he checking it? He's checking the financial issues. Checking the financial issues. Please, the details of things under the financial issues have been dealt with. So if you have to go back to the audit planning and risk videos, go back there. Then you have to check operational issues. You have to also check what? He said what? Reputational issues.
Or compliance issues.
Yes, reputational or compliance issues. So if they are not compliant, then it means going concern it as risk. Operational, if they lose quality staffs, key staffs are going, machines are breaking down, impairment, all the impairment is happening. Financial, I think financial, we said you use the element of financial statement, right? Asset,
Yes, sir.
equity, liability, income, and what? Expense. So if expenses are going up, look out. Income is coming down, we call it impairment, look out. Asset is coming down, impairment, look out. Equity is coming down, look out. Liabilities are going up, you look out for those issues. So that is that. That is that. Now, if they are losing key suppliers, I mean, you will see it. Come on. You see something is wrong. If you read the story, you definitely see that something is wrong. Now, what do? This is what the examiner does. These are your possible exam questions. Exam question type 1. There are 2 potential exam questions. 2 potential exam questions in this area. If I say 2 potential exam question area, trust me, I have gone through all the past questions before I can conclude on this. Case 1 is that, 1, you'll be given a case, a story, a case study. And the examiner will ask you that, provide indication of going concern problem. Fish out the indication of going concern. And please, those are the things I've said up here. All those things. All right. So that is that. In that case, when you are answering the issue, don't just pick out these issues, the reputational issue, operational issue, and that is that. Don't just quote it. Lead the problems. All right. Lead the problems. What do I say about that? I mean, talk about the effect. Talk about the effect. Leading to shutting down of the company or the company winding up. So talk about it. So let's say they are not complying. You tell them that, okay, if they are not complying, the compliance entity like EPA by regulation can close down the entity. So lead all the statements you are saying to a shutting down. If income is coming down, they will not have money to pay staff. They will not have money to pay their liabilities, which will lead to a shutting down. So that is that. So end it like that. That is the first type of examinable question you can get. All right. The second examinable type of question will ask you this. It will ask you this. What are the audit procedure to tell that there is a going concern problem? Audit procedures. So the second question is about the audit procedures on going concern. Ongoing concern. This one, you have to be very careful. So audit procedures to assess the going concern of an entity. The first thing you need to do as this is, one, you will need to review their cash flow forecast. Review their cash flow forecast. So review and discuss cash flow forecast. Every entity has a cash flow forecast. And on a friend of budget. You can't tell me you are an entity. You see yourself in the next year, but you don't have a budget for the next year. That is not how a proper entity is run. So you have to review the forecast. You have to review the forecast of the cash flow. And when you do that, perform a sensitivity analysis. What do we mean by that? I'm coming to explain to you. Those of you who have done FM before, you know what sensitivity analysis is. Now, the forecast is going to show you that they are expecting some inflows, which is their revenue. They are also going to do some outflows. All right. Anyway, let me ask you this question. Is Ghana on a going concern? Is Ghana on a going concern?
No.
Ghana is not an ongoing concern.
Yes.
I just say a ton your cry still a per capita income and so on. All right. So Ghana as it stands, okay, it's not an ongoing concern, no problem. Country are with him, who's an ongoing concern. All right. So you review the forecast. So the company, you review their inflows, their expected inflows, and their expected outflows that they want to make. So that is what you review. And you ask yourself a question. Okay, if the source of inflow A doesn't happen, what will happen to the entity? That is what we call sensitivity analysis. So for example, I have not taken a look at Ghana's budget, but those of you who do public sector, I think our inflow comes from direct taxes and indirect taxes and petroleum revenues and donations, grants. Those are our major source of revenue. Is that not it?
Yes.
Sure.
Okay. Me, I teach tax. One of the principles in tax planning is according to Judge Leonard Hunt. He says that tax planning is an activity that everybody does. The poor man does it, the rich man does it. So asking the citizen to pay more than he should is a mere cant. So for example, I heard one of them. I'm having a feedback. Who is that?
Please, I think it's Brother Charles.
All right. So one of the things is that you said that if we do Momo, you tax me 1% on the Momo charge above 100 Ghana. Then me too, whenever I have to send 1,000 Ghana cedis to somebody, I decide to do it 100, 10. So that I won't pay the 1% on the Momo charge. If it is on a different days, I'll do it different days. I won't do it one day now, Kobro. So all that I'm doing is not to pay the Momo tax. Then I heard one politician say that we've not been able to construct your road because the money that we were expecting from the Momo tax, you people didn't do Momo, so we couldn't get the tax to do the road. If I hear a politician saying those things, then I just conclude by saying this guy is just a decorated illiterate. That is it. You can't ask me to do Momo for you to tax me when I can avoid it. It doesn't make any sense. So you see, the sensitivity analysis is that, okay, what if government did not get the money from the MOMO? We all know that they didn't want the MOMO money to do road. That is not what it was about. It's like Ghana is short of funds. And that is what happens. They wanted money. So you look at the entities inflow normal project, then you start making some analysis. If they don't get that inflow, what will happen? So are you getting the picture? So that is what you do. You assess it. You do sensitivity analysis. If something is to happen to one of the variables, what is the effect of that on all the other variables? And please, this one, this forecast is the one that the examiner can actually bring you a whole financial statement last year and this year. Yes. And they are projected ones if possible. Because you have to assess going concern, you may have to be doing ratio analysis. And see, no cranium. And that is why I get shocked when students are not doing corporate reporting in addition to advanced audit. And you don't expect that I will be teaching you ratio analysis. It's not possible. Because this is not a corporate reporting class. So if the examiner, just in case the examiner now put the question there, but assess the going concern, you are going to calculate profitability ratios to see. You are going to do quick ratios. The what do you call it? The current ratios and the asset test ratio.
Yes.
Are you saying that? And no, just a material or audit one. It is dangerous. So I don't know who advises this combination, sincerely speaking. So if this thing is to come right now in like that, what are you going to do? And it is going concern. It is going concern. But good for you. The last time they did that, let me see. The last time they did that type of questions, let me see. Let me just see. You see this question. So this is one. This is not from. This is from ACCA. I think Ghana. No. Yeah, this is a question I picked from somewhere. So you will have to do all these kind of analysis. Have you seen it? So all those analysis. We will solve the past question, all right. But I think there is a question on going concern. Later on, you'll find it that you have to be doing that. But for example, this one is a past question. So as part of my teaching, I will bring it up. We will do something like that. Because that is what I use to teach going concern in the book that I've written. That is what I use to teach going concern. You see the draft and you see the actual. Yes. So I use that as a tutorial guide in the book. Yeah. So sometimes do it for the overall review and all those things. Okay. So please, there are some of the things, and I don't think ratio is a problem anyway, because even if you did masters, you did ratios. Even if you want to invest in Kwandia and you did something related to accounting and finance, definitely you will do ratios. So it is just a small revision you have to do. Yeah. And I think ICA2 has examined it one time. Yeah. It is in the past questions. Those of you who have the book, if you scroll down, you will see that it is there like that. Yes. So please, sign your money there between one, but God will have mercy. God will have mercy. Anyway. So as an auditor, what you do is to do sensitivity analysis, review their cash forecast, cash flow forecast, and conduct a sensitivity analysis. All right, that is that. So what are you doing? You are analyzing what they have, all right? And so check their bank statements. Check bank statements. What do they even have? Check their receivables. How much are they expecting to receive? Later on, we will do the difference between forecast and the other word I've forgotten. It's part of the non-assurance review. All right, we will look at that. We will look at that. And projections, yeah, we will look at that. All right, so we will look at that probably next week. So you perform the sensitivity analysis, all right, so that is that. So that is what you do. Then what you do is that you review their correspondence. Okay, yes, Ejapaye.
Sir, can you
Yes.
scroll up a little
To which part?
before the two potential exams question?
Hey,
I wanted to check.
are you asking a question or you are writing something?
Hello, sir.
Yeah.
Sir, please, it's okay. I'm okay.
Are you writing something? Okay. Is it okay? All right. So that is that. Now, the next thing to do is to review their correspondence. Review their correspondence. As an auditor, you have to, what do we mean by correspondence? I mean, their interactions with their, correspondence simply means interactions, all right? Correspondence, like letters between them and some other parties, i.e. other parties like the customers, the suppliers, the banks. Okay. So why are you doing that? With the suppliers and the customers, you are checking up if there is any disputes or legal cases. And the legal cases, last sitting, and I don't think anybody here wrote last sitting. You saw that they brought in the legal claims. All right, that is that, the legal. All right. Then the banks too. You check correspondence with the bank to see if there's the likelihood that they can get loans. All right, likelihood that potentially they can get loans, so that in case of any issue, they can get loans to back themselves up. All right, so that is that. That is that. Again, what you also have to go ahead and check is also the board minutes. The board minutes. Because if the company is going to wind up or go on liquidation or anything, it will be inside their board minutes. How do they address? How is the board addressing going concern? How are they addressing going concern issues? So if they have huge liabilities, there must be a board meeting that is there that will tell you what is going to happen. All right, so that is that. That is that. Number 4 is that you have to obtain written representation. I think we've already explained what written representation is. So obtain written representation. Don't let them open their mouth just to tell you that, oh, they are on a going concern. So obtain a written representation, all right, about their going concern status. Last one is that ask their lawyers, the company's lawyers. So inquire. You see, all these things that we are doing, can somebody see that we are applying what we learned in audit evidence? Do you remember the AEIOU, the Dada Gobe, and the Coca Cove Kovu? Are you seeing it in there?
Yes, sir.
I don't just say
copies.
To do something for a purpose. Okay, you don't just obtain the written representation. You obtain the written representation for a purpose. To see how management is addressing going concern issues. All right. So you don't go to the exams and say obtain written representation. Full stop. Please, we've gone past that. Yes. So inquire from the entity's lawyers. All right. from the entity's lawyers if there is any what pending litigation that affect going concern. All right, that affect the going concern. So these are the things you do when it comes to you assessing the going concern of an entity. Going concern of an entity. All right. So that is that. That is that. All right. So that is it. That is the part on going concern. That is the part on going concern. So look at this. Look at this question, for example. Of course, today is not in my plan for us to deal with past questions. I want us to finish what we are doing. And prior to the, so let's say we finish everything this Thursday. Say, career syllabus now this Thursday. From this Thursday up to the next Thursday, I give you the opportunity to say, because that point when we meet, it's all about past questions. So therefore, and I think we will have like 2 weeks for that. And so that one, you don't come as if you come as if I want an opportunity to express myself because I may not get the time to study it before the exam date anymore. So I give that chance. Into your boss while you lift it. That is it. That is it. So you don't wait. You don't wait. Now, and what I wouldn't appreciate, and I think I've already said it, that when we get to the past question, that honor, then you tell me, oh, sir, when you were treating this thing, I wasn't there. Can you go over again? I see. Then what happens to you missing class and you going to your Telegram page to actually watch the video? Or what will happen to that? So I don't tolerate those comments when it comes to that day. Those ones I don't tolerate. Yeah, because or person expressing, you are not coming to be a blockade. And you see, this thing I've said, when the time is up, you will definitely get somebody who will do that. Because your number is not the number that I've seen in joining this class. No. Most of them didn't join. And so you definitely have somebody who will do that. Yes. And when I give that person that response, the conclusion of that person is that the teacher is rude. Me, I don't care. Yeah. I don't care. Those when it gets to those things, cry there, man. All right. So please, it's either you've joined the class, you are listening, or you've joined for me to know you've just joined, but you are not listening. So therefore, you go back and watch the video. It depends on you. It depends on you. Now, let me just give you a bit of how this thing looks like. Look at this question. On July 1st, it is July 1st now. So in audit, you assume a life, so you assume yourself to be in this date. Adale has been a client for your firm for 3 years, and you are the newly appointed audit manager on the audit for the year ended March 2015. Dale company is family owned, unlisted, which imports motor cars. The company buys cars from a variety of car manufacturers for sale to car dealership, and vehicle leasing companies within its domestic market. The audit for the current reporting period is nearing completion, and you are reviewing the working papers on the going concern section of the audit file. This is the extract of the draft financial statement. So you see, this is last year's own. That was the actual, right? And this is the one that has been drafted. So you see that. You see that. All right. So you start checking it. PPE now 14.6, you see about 13.5. You should know what has happened to it. 3.7, 5.8, you'll be looking at the figures. Their cash at bank was, so if you don't have cash at all at bank, but you have an overdraft, don't you think that thing should tell you something? Yeah, you don't have cash flow forecast. Do you remember? Don't you
Yes, sir.
think this thing is telling you something? Last year you have 0.6 million. This year you have share. Your money has now gone into receivables and inventory. All your money has now gone into receivables and inventory, but you don't have nothing. Now, only cash, salary bar out the day in a bit here. Are you getting the picture? But
Yes, sir.
not this year no munya profit. There is a financial term we used to give to this. A company that is not having cash but more receivables and inventory. What is the financial term for that? Those of you who have done financial management before, what is the financial term for that? Finance.
Over trading.
Over trading. Yes, that is it. That is what it is called. It is called over trading. All right. Profit pound. But unfortunately, even amidst that, this year was a profit, this year is a loss. Can't you see that everything is trying to tell you that? Let's look at their liabilities and see. Let's look at it. Their capital there to be the same. Retained earnings has reduced drastically, telling you that probably they've used all the money to pay dividends. Look at borrowings, long-term borrowings. That one is even slighter. So they paid borrowing. And you can see here that provisions. Provision is a creative thing. No? Why have they increased their provision? It's a creative accounting sort of thing. Now, payables have gone up. They have overdrafts. So you can see. You come to their revenue. So Omu making revenue. So fine. Cost of sales, gross profit has increased. But look at their operating expenses. Look at the change. Into here, ahanum ye the ratios kakra eye adwuma. Operating profit is now a loss. Finance cost has increased. Tax. Obviously, they have a tax gain. So the net profit or loss is this. Now, it gives you additional information. Dale has undergone a period of rapid expansion in the recent years and is intending to buy a new warehouse facility at this date at a cost of 4.3. Now, wow, what the only cash? What the only cash? Who say beto something like this in August? Have you seen where we are gearing to now? In order to finance the new warehouse, the company is in the process of negotiating a new finance with the banker. The loan application amount is 5 million, and it will span a period for 5 minutes. The provision of 3.5 in the financial statement relates to legal action. Court. Yes, and that is what they are going to pay. So it's a right provision that they've done. Those of you who know IAS 37, that is the correct thing that they've done. And so it says that the action relates to a claim that the company has sold cars and did not comply to the domestic regulation. Going concern. Do you remember compliance issues? And I told you when I was doing that thing is that if you remember when we started this class, I told you about laws and regulations, Ansah 250. Do you remember that the fact that if they don't comply, it is an issue of they can be caught and they pay penalty, or their company can be shut down. So, which means that it is an issue of disclosure. All right. So you see that clearly here. It says that the going concern working papers include cash flow forecast of the 12 months ending 2016. Rightly so, and that is what we just learned. The cash flow forecast assumes that the revenue will increase by 25% in the next year. Now say increasing so by 25%. That's the sensitivity analysis we talked about. All right. 25% next year, following a reorganization of its credit control facility. Its customers will pay on average after 60 days. If you know your IFRS 9, and these are the things, you see, corporate reporting and your money be bear for amount. If you know your IFRS 9, it says that any debt, so any debt that is after 30 days, that it will be overdue after 30 days, is a credit risk. It's a credit risk. Like the way Ghana, I do downgrade. And says that the forecast assumes that the bank will provide a new finance in August. So that 5 million or more, the bank will provide it and will have a positive cash flow of 1.7 million. No more provide them out crowd what they call warehouse. per the question. The financial statement has been prepared on the going concern and makes no reference to the significant uncertainty relation to going concern. You are required to evaluate the matters that cast doubt on the going concern ability. Didn't I tell you that? Which scenario is this one? Which exam scenario is this one? Which potential exam question is that? I told you there are two potential exam questions. Which one is this 8 marks?
The second one.
There is the first one. The leading.
I think the first one
The first one
was the application of going concern.
Yeah. So have you seen it? And that is all. So going concern a bank one day, no. So a question like this that I put in the book, you don't joke with it. You don't joke with it. We are not going to solve this question today. I'm just using it to show you something. But if you have the book, why not go through it yourself? Then explain the audit evidence in respect of the cash flow forecast that you expect during the review of the working papers. Which question type is this one too? Is it not the second one?
One that shows the procedures.
Exactly.
So that is the procedure, the audit procedures for the review and the
Okay.
discussion
It
in
says
order
to
to determine the flows.
notes to the discussion with Dali. You have established through discussion with Dali company directors that they do not wish to disclose uncertainty over the going concern status. Explain the possible reasons why the directors may wish to exclude these disclosures and evaluate the possible implication to the audit report. We will learn that. We will learn the audit report. How these things affect the audit report. So here are we 5, 8, 7. Complete 20-mark question for your question 3. Now to all. Now to all. No, be a wire corporate reporting or shall no straight. But this one, you don't even need corporate reporting. It's a ratio analysis. You assess profitability and those things. We will look at this question later on. We will come back to it. But if you have the book, do it even before we come. Because you are going to do ratio analysis. You are going to do all those things. Like you can see, the ratio analysis is being done. Profitability, gearing, just to give you a glimpse of it. Legal claims, no, the cash flow forecast. Then the evidence that you need to get, audit evidence, the procedure is also there. It's here. So we will come back to that and repim. We will come back to that. So get prepared when we get to that area. All right. So you see, I made mention here that you need to get written representation. This one. What is a written representation? That is Ansah 580, a written representation. So that is one of the things that you also request from the entity. So we call it a written representation. All right. So we are the next thing to do. You see, we are doing the ISS one by one. Right now, I did 560. I've done 570. This is 580 written representation. Okay. So what is written representation all about? Already, I think one of you have already given us a clue that it is the letter from who? A letter from who? A letter from who, please?
Management.
From management to the auditor. So if the auditor finds something out in the financial statement for which he wants evidence for, just like evaluating going concern, he will ask the management. And the management response to that is what we call what? A written representation. So let's look at written representation. So that one will be Ansah. I told you that in the Ebeche Kakra, Meboa. And I'll give you break. Because I want to finish this. Person me win them. Near to me time, near drilling on the questions. Written representation. If I had not done all those practical past questions and things, we would have finished the course by now. Yeah, sincerely speaking. But it was very necessary we had to do all those things. All right. So that is that. We learned something about getting these things. If you remember when we were doing the evidence thing, we said that don't take words of mouth for that. You take it written. You remember evidence that written is more reliable than what? Oral. So please, here written representation, that is the reason why. So to avoid misunderstanding and to avoid manka nesano, you have to take a written representation. So that is a symbolism of management response. That is what a written representation is. Management response, a written down management response. All right. So that is that. So you want evidence, but you can't find the evidence. You take written representation for that. That is what this thing is about. First of all, when you enter into an entity to audit them, you need a written representation on the status of their internal control. So written representation is obtained on the status of what? Internal control. It happens. Our financial statement, we have quality staff, we have this, we have prepared a financial statement by quality staff. There is no fraud in this office and all those things that they say. Those are the things that they say. All right, so they do that. They do that a lot. You have to also obtain a written representation or on all transactions that are related party basis. So get it also on related party transaction. Related party transaction. In accounting, this is IAS 24, but here we call it ISA 550. All right, that is that. So you have to get that one too. Any subsequent event, the one that we just learned, ISA, if they see it, they tell the auditor, and I think Adelaide summed it up. They have to put it in writing. Adelaide, you remember? You said it. So subsequent event, 560, ISA 560, where I said that the accounting standard is
Yes, sir.
IAS 10. So that thing you said that they should write it, you need written representation for that. So that is that. And again, lastly, going concern issues, we have just learned that they have to state their going concern status. So that one too, you need written representation for that. That is ISA 570. So if the question tells you what are the various instances where you demand going written representations, these are the areas that I've hinted for you. All right, that is that. That is that. Again, you will need their written representation involving general management judgment. So the things that are judgmental based, all right, matters that involves management judgment. Who can tell me those ones and the accounting standard that relates to that? Matters involving judgment. So you can use your preferential management preference to actually do it. There are certain things in the financial statement that is open to your preferential treatment. So management judgment, who can tell me the accounting standard that allows that? Those of you who do corporate reporting and FR, there is a standard called IAS 8, accounting policy. All right. Nobody tells you the useful life of your asset should be 20 years. Nobody does that. It is your own judgment. So you will need a representation from management as to why they selected those things. As to why they selected those things. So please, that is that. That is that. So management representation is just a documentation of things that the auditor may need from the management, which are the things that management actually use their own preferential intentions on. So that is that. That is that. So you need written representation on all these things. So the matters that should be included in the written representation letter are management. So for example, when they are giving you the written representation letter, there are certain things that must be present. So we have general matters and we have specific matters. All right. So the specific matters, a typical example of these specific matters is this one. Yeah. So that is that. But the general matters are that we all know that the financial statement preparation is the job of the management. So you have to get written representation that the management or the directors has fulfilled their responsibility of so they must state it that they prepare the financial statement. Those are the general ones of preparing the financial statement. That is why I told you that they say we have prepared the financial statement. It was done by our great audit team members. There's no fraudulent activity and all those things. And that after they state all those things and that they have provided all relevant information, they have provided all relevant information to the auditor. This is a general one. This one is the one that you take immediately, including the going concern status. So they state it. It's a BBI legit. We have provided all relevant information to the auditor. So it means that if the auditor, you see, so a auditor now goes on to see that there is something not provided, it raises an alarm. All right. So that is that. That is that. So again, don't forget, I told you that they must state in there that all frauds are communicated. What is the audit standard for fraud? So do I have the Deloitte sample? I don't think I'll have it. If I have it, I just make sure the platform. So, but it's just that it's for my company and confidentiality issues. So I may have to block out some things, even if I find it. So I told you, we have the responsibility of preparing the financial statement, and we have given you all relevant information. For here, in this entity, there is no fraud. And even if there is fraud, they have communicated it to the auditor. Laws and regulation, please, fraud is ISA 240. Laws and regulations are adhered. So they say all those things in the management representation. Laws and regulation is laws and regulations. Laws and regulation is ISA. Who can tell me the ISA standard? But it's ISA 250. All right, so that is that. That is that. All right. So if there is any effect of uncorrected material misstatement to it has also been communicated. All right. So everything has been communicated. This is what goes into your written representation. Specific matters are matters that are involving judgmental issues. These are specific ones. So this is your written representation. That is what goes inside the written representation.